Welcome to Market Movers. I'm Jim Murio, and today we're looking at the first 100 days of the Trump presidency. What started out as a promise of radical economic policy change has kind of morphed into something a bit different. We're going to be looking at 10-year weekly options as a way of positioning for risks in the coming months. Joining me is Chief Investment Officer of Kingsview Asset Management, Scott Martin.
Hi, Jim.
Scott, what's your broad take on the Trump presidency?
I don't know how much time we have, but I'll tell you what's been interesting. As we've gotten into the relationship, hasn't it changed a little bit? I think there was a lot of excitement. There was a lot of promise. There was a lot of hope for the markets and economy as we saw the election turn out the way it did. And it's kind of changed over the course of the relationship to maybe more disappointment and uncertainty.
Is it all, when you say disappointment, is it mostly from the repealing of Obamacare failing? Is that mostly what you're talking about?
Yes, and I think the rhetoric, Jim, of phenomenal tax policy, regulatory reform, all these things which have not really come to the forefront yet, and I would argue have actually lost a lot of momentum.
Okay, well then you mentioned something interesting. The other things that had been talked about during the election. What do we need to see or not see to have the biggest effect on markets in the next 3 months?
Well, you need to see some progress between the House and the Senate with respect to how aligned they are with the president, because you kind of have Paul Ryan and you have Donald Trump and then you have everybody else, it feels like. So some coming together of the Houses of Congress as well as Paul Ryan and Donald Trump, I think would be a big benefit.
Okay, for me, I'm looking at for them to stop talking about tax reform and start talking about tax cuts like they had before, because that's what the market wanted, and that's why we had that big run-up. What about the budget? What about that?
Well, the budget's a key point to everything you talked about with respect to tax reform and health care. And there again is going to be some sort of agreements that are going to have to be made where we're going to have to inflate the deficit. That's the problem. People don't want to do that.
Right. I'm looking at those negotiations as a signal of whether or not they can get along at any time. Now, before we dive into our trade discussions, I'd like to point out that as with all market movers, it's important to view these trades as examples that allow you to see different ways to use futures and options products to manage risk or create additional trade opportunities, not as trade recommendations. Prices and movements will vary in the markets. The June 10-year is trading about 126.0708 as we talk about this, Scott.
This has been a contract we've talked a lot about on the show this year, and frankly, we've been on it pretty well. So I like staying in the 10-year ZN here to try to get a feel for how things are shaking out, and specifically today looking at the 127-128 call spread. Right now, it's going to be about 15 ticks or so. This goes off on May 26th, so it's the June, but it expires on May 26th. The trade risks about 234 to make a potential 765. Now, what's interesting about these levels, Jim, the 127, 120, that's back to just about the close, believe it or not, my friend, on November 9th when the market went crazy after Trump won.
And I'm going to go the opposite way, but there's some stuff I like a lot about this trade. The fact that you can pay 15 ticks and make a full point is a pretty good bargain, in my opinion, particularly when that lower strike is only a point and a half above where the market is.
And look at the ZN chart. It's kind of in no man's land, too, so there's no reason it can't get back down there as far as
I agree with you. The chart looks strong to me. I am going the opposite way because I think fundamentally things are different. I think we've priced in a lot of panic, a lot of global panic, French election, the Brexit talk. North Korea. Bombs are going off. There's a lot of bad things that have happened recently. So I think we could get back on a more positive thinking, particularly as we chew our way through earnings season. So I'm looking at buying the June 10-year ZN 124.5, 123.5 put spread for 10 ticks. The ZNM, the June contract, is the underlying. It also goes off May 26th, just like yours. And it risks $156 to make a potential 843. So mine's a smaller outlay for a bigger reward, but it's also further away and less likely to happen. Thoughts?
And a good point in the sense that if you look at this ZN, the move has been staggering. I mean, there's been a huge pull down in rates, and obviously the ZN's inflated. So it's something interesting to look at with respect to how that turns out if it rebounds.
Now, the rates have gone down. Prices have gone up in the 10-year alongside gold, VIX, Japanese yen, all the traditional risk-off assets except for the U.S. dollar. So to me, it's indicative of global worry more than it was worry domestically. Do you agree with that?
I agree with that, and that's what is interesting, that it's getting priced in here. Depending on how that results, maybe this is an overreaction.
Understood. Thanks for joining us in this special edition of Market Movers. I'm Jim Murio, where we're helping to make you a better trader.